quantitative easing, call option balance sheet, current yield, tea party, occupy Wall Street, summers and cool speed, guy, Bernanke, junk bond, hedge fund, NASDAQ liquidity, too big to fail, got the equity ratio, T-bond, T-bill, T-note portfolio, Paulson, Volcker, GDP, odd lot, profit margin, ad film, current yield, preferred stock, money cents at the opening bell, money cents at the opening.
Good morning and welcome back to Money Sense at the opening bell. Jim LeCamp and Pat Riddell, we are Senior Vice President, Senior Portfolio Managers at Macro Portfolio Wealth Management at UBS. The website is money-sense.com. Our latest newsletters on there, latest house view, complimentary financial plan, all at money-sense.com. The market data we bring to you every day comes to you from Thomson Reuters. Our guest now is Mark Minervini. Mark, we've had on the show recently. In fact, he was telling us about a trade he had made, and it appears it worked out pretty well. We're going to get to that in just a minute. Mark is a author of a couple of books, as I mentioned in the previous segment, on Wall Street, and they're very, very good books. The latest one that I read was Trade Like a Stock Market Wizard. He's also prominently in Momentum Masters, so he's got a long history on Wall Street, won the U.S. Trading Championship, almost won it twice if it wasn't for some sort of a marketing hiccup, not a fault of his own. But and Mark's opinions are his own. We have to put these disclaimers in. Oftentimes they will conflict with our house view here. They are his own, and we respect him quite a bit. But just so you know, those are his opinions.
Mark, welcome to the program. Let's start with a term. I want you to give us a little education first because it's a technical term. But in your view, the market melted up. We're going to go back a few days here. You were on the program 2 or 3 weeks ago. You said the market melted up. Define what you mean in this case that the market melted up. That was one of the reasons you were so committed that we were going to see a drawdown like we saw. But the melt up was key. Is that correct? And if so, explain to us in detail what a melt up is.
Yes, the last time I was on the show with you, which was just recently, I guess a few weeks ago, I talked about a parabolic move in the Dow Jones and that a melt up always leads to a melt down. So a melt up is when you run up at an unsustainable pace, and usually you turn parabolic, where you start accelerating to the upside exponentially, and you get steeper and steeper. And it's just at an unsustainable pace. And when we looked at those melt ups going all the way back to 1900 and found that this particular one was starting to really push the envelope, being up about 22% in 99 days. So, and then again, of course, we needed a catalyst to get that trend to change. And that was what I also talked about back then was the interest rates moving up and some type of inflation scare.
And when you talk about the interest rates moving up, you're talking about the 10-year Treasury. Is that correct?
Yes. Well, we already have the Fed raising rates, which that's baked into the cake. But now when we see the 10-year, it got above 262. It really started to, I think, unnerve the market when it got above the 271 level. That's another level that I've been talking about for a while, heading towards 3% now. And at the same time, we saw wage inflation move up. We saw a rise in the workers' wage inflation, 2.9% year over year, and that really was the scare that I think put the fear into the market here. That maybe the Fed will now have to raise more aggressively going forward. And a stronger economy might start to work against the market here.
One last question on the rates there before we move forward. The 10-year got up to 288, 290, something like that. Now it's settled back at 277, and the markets, at least yesterday, seem to have calmed a bit. I doubt that calm will continue one way or the other. But if the 10-year was to remain in the 2.75 to 3% level, is that, in your view, harsh on the market over a longer period of time at that level?
Well, I think the market now coming in here has discounted some of that. So we might have adjusted here, relative valuation made an adjustment because interest rates, your valuation on the market in a good large part is based on where the interest rates are. So if the interest rates were to move up from here, that would obviously change the valuation on the market because interest rates are calculated in that. So we've made an adjustment, and now we don't know if that adjustment is adjusting to current conditions or how far the market's looking forward. So the market's a discounting mechanism. It's going to look forward. The real question is how far forward it's looking, and that's really the $64,000 question.
To your point about a valuation adjustment, I tend to agree with you. One of the things we noticed was the group action. It wasn't your typical bear market risk-off action in that the NASDAQ actually held in a little better than the S&P and the Dow. And the leading groups, if you want to call them leading, I guess the least damaged groups, and the ones that rallied a little bit yesterday included materials, consumer discretionary, and technology. Hardly a risk-off move. It felt to me like, again, more of a revaluation move. Would you agree with that on the group action?
Well, I think your assessment or your impression of what happened is correct. However, I do think this is definitely a risk-off environment as far as money managers are certainly moving to the exits here.
Sure.
That's when you see that type of volume in the market, that's not Aunt Betty doing the selling. So, when you get such a strong downside momentum like this, it suggests that risk is still high, and you should expect volatility to continue in a risk-off environment for a little while. Mm-hmm. Right now, the long-term trend or the bull market trend is still intact. This has not broken the longer-term trend, but because when you're in such a long-term trend and when you go parabolic, it takes a big move to break that. You could already be at a large loss before that even happens. So you have to be, when you get these parabolic moves, you have to move quickly as that intermediate or shorter-term trend starts moving against you. So right now, of course, the last time I was with you, I talked about, I think I shorted the market the day before I was on your show. Mm-hmm. We covered it on February 5th, and we covered it right near the lows when we were off about 1,500 points intraday. Currently, I'm in 100% cash. So okay. I think that there's a chance that we could make a lower low here. It doesn't have to happen, but there is a chance that the market could even go lower. I mean, you just don't know, and you
right.
really need it. You should wait for the market to stabilize here, and it's better to get the right price than the low.
I tend to agree with you, Mark. It's 8:12. We're up against a break. The Dow futures down 170 points. Let's stick with this topic on the other side. Our guest is Mark Minervini. We'll be back with Mark in just a couple of minutes. You're listening to Money Sense at the opening bell.
Welcome back to Money Sense at the opening bell on this hump day Wednesday morning. The markets are down. The movie will start in about 13 minutes. And when it does, of course, we'll give you all the details of that. Mark, former U.S. investing champion. And, Mark, I wanted to get into a couple of things here with you. You are, by definition, I think it's fair to say, a trader. Is that fair? Or a swing trader in some way? You're very active. Is that fair?
Yes, I'm not a day trader, but I am a shorter and intermediate term, weeks to months, not years.
Yeah, in a market like this, where you're making big market calls, and then you're implementing those calls, as you were last time you were on the show. At that time, I remember specifically you talking about how you had been short the market and were a believer that something was on the negative side was going on. What is kind of your tool of choice, or is there a tool of choice? And by that I mean, are you shorting the S&Ps? Are you buying puts? What is the actual tool that you use if you believe the market is going to go down?
Well, it depends what area I would think would be vulnerable. So in this particular instance, I thought the Dow Jones was most vulnerable, so I shorted the DIA as opposed to using some kind of, and you're hearing a lot about these levered ETFs. The reason I stayed away from them is precisely what's happening now. They don't track well and so forth, and there's some other problems. But so I just short the DIA. You could short, if you wanted to short the NASDAQ 100, would be QQQ. The SPY would be the S&P, which would be basically the same thing as the Dow. So I chose the DIA.
Let's look forward a little bit. You say now that you've closed out your negative short. Now you're cash. You're looking for an entry point. Do you have specific triggers in mind? Are you screening? What is what are 2 or 3 things you might that might be conclusive for you to re-enter either short or long?
Yeah, well, at this point, as the market comes back here, and if we were to maybe move up for a few days and it was a dead cat bounce and volume wasn't very good, you'd probably set up another shorting opportunity maybe to get either a trip to lower lows or a short-term trade. But I would stay away from the market now for a little while because the volatility is going to be very, very heavy. You're going to see wide swings. We traded in a 1,000-point range yesterday. I mean, that's just for a volatility trader or a short-term professional trader, that's a great environment. But for the average guy, that's a nightmare. Lots of Pepto-Bismol. So I mean, right now, what it would take for me to get back in the market would to see stock setups. That's the main thing, are the stocks. So I'm mainly a stock trader. This is sort of going off the path for me to start buying or selling indexes. But I thought, like I said, there was an opportunity. So, and seeing the market stabilize and seeing better action within the market itself, looking at the indexes and looking at the price and volume, basically.
What areas of strength have you seen in the last 4 or 5 days? What areas have maybe held in stronger comparatively to the rest of the market that, in your view, at the moment, have the best chance of setup on the long side?
Well, there's been some individual names. There are a small handful of names, but you got to realize that they may get to those too. You just have to be more careful. I wouldn't get too excited about stocks that held up or the areas that held up just yet, because if this market has another downdraft or experiences a lot of volatility, you may still get whipped around quite a bit. So, as far as group work is concerned, I really couldn't tell you. I haven't been looking at the groups I've been holding up. I more look at the individual stocks, and then they lead me to the groups. But I've been more focused on, what the market is doing here in the next few days, because I don't plan on doing much buying of any stocks for the next few days. Once we have a decline, a sharp decline, and the market gets under distribution like this, I usually ignore the first few days of rally, certainly the first 2 or 3 days of rally, and then start to see if it wedges up higher and sets up another short. I'm not usually coming into the market. I'm waiting for it to stabilize. You got to think of the market as sort of like an injury. If you sprain your ankle, it might take a week to repair. But if you broke your leg, it would take months to repair. So the severity of the decline and how strong the downside momentum is will give you an idea of how long it's going to take to recover. And this is at least a fairly decent sprain, and maybe even a break here if we go much lower. So that's going to take a little time to repair.
You've written a little bit about the presidential cycles. We're in the second year of the presidency, also a midterm election year. Will that impact the markets, in your opinion?
Well, we're entering a seasonally weak period on 2 fronts. First, the presidential cycle, the second year of a presidential cycle going into the second quarter is weak going into the third quarter. So this is sort of setting up perfectly at a weak seasonal time. I don't put a lot of weight in the seasonality, but those are the facts. And the other thing is that when you have a new Fed chairman, usually the market rallies into that Fed chair change, and then the market declines and then moves sideways for a number of months. So seasonality-wise, the Fed chair change and the presidential cycle are both lining up for a correction and a consolidation here. So it's sort of playing out perfectly right now.
The inflation rates are a big source of debate right now. The 10-year Treasury rates are a big source of debate right now. Do you look at macroeconomics, or are you simply looking at the action of the markets themselves and getting your clues there?
No, I always look at the macroeconomics. We do a lot of work on that every week in our study sessions. And, right now, the longer term, the bigger picture, macroeconomic picture is still supportive of a bull market. Doesn't mean we can't have a cyclical correction. I mean, even the 87 crash, you could make an argument that that was a cyclical downturn within a secular bull market that continued. 98 was a cyclical downturn within a secular bull market. We went higher. So these cyclical down corrections in bear markets happen within secular bull markets, which I think we're still in, and means we could still go higher here. But what you have to look for, what's important now is we just had an amount of optimism. You know, you're asking what led me to that conclusion and what would lead me to a conclusion that will go, back in the market. Well, looking at the sentiment numbers, you can look at the investors' intelligence numbers. There's a lot of sentiment polls. We were at incredible extreme bullish numbers that will go back before 86 or 87, before the 87 crash. That was one of the reasons why I was pessimistic on the market, because so few were pessimistic. Now we want to see that change to where we see a lot of pessimism in the market and everybody gets bearish. And that will be, that'll give you an indication that they've all done their selling already and the market has washed out.
Whether or not the market goes down or up from here, though, I do note that I'm not seeing right now, say, as compared to the most recent, panicky kind of market, which I would call January of 2016 was the last time we saw any real heated up panic, at least from our vantage point. I still have seen very little panic out there. I run into people on the street. I talk to other investors. We know lots of money managers. I don't see much panic yet. It seems to me there's still a lot of bullishness around, and that's reflected in the sentiment numbers. Would you agree with that?
I think that's a very correct observation and a good observation, and I'll tell you the way it generally works with emotions and human nature with the market. When you have a fast slide, people tend to just hold off and say, well, let's just see what happens, and they don't get too nervous very quickly, even though the slide might be very, very deep. You might have a big pullback in the market. Time is a much more powerful force. For instance, if you just came down, 10% in the market, you might get investors say, well, I'm going to hold here, see if it snaps back. But if the market just drifted off slowly for, let's say, a year and just kept going lower and lower and lower, and that same 10% pullback occurred, but it occurred over a year and it was just dripping on you, it would affect investors more. It would be more likely to get worn out. So time is really important, and that's what I'm saying. This is going to take a little time to rebuild and to go through that building process to be able to get that pessimism maybe to build up. So you're right, and that's why I think the market maybe could go lower here, because I still don't see the type of worry that probably should be associated with such a sharp pullback.
And that's kind of an interesting path to go down a little bit. It's not necessarily about investing and going long or short, but it is kind of interesting to note that in the context of the economy seems to be better, the economy seems to be growing, tax reform seems to be a positive, earnings for corporate America seem to be on the right. There's a lot of good news out there that kind of separates from some of the things you're talking about. Would you agree with that?
Yeah, well, that's what throws the average investor off. Is they, when the picture looks bad and there's a recession, they're not thinking about buying stocks because things are so bad. But bull markets are born out of recessions, and bear markets happen when the economy is growing strong, and then the Fed starts to jack rates and they engineer a recession. So at this point here, though, we don't see the type of inflation or strength in the economy. Real GDP would have to go, over 4%, get to the 5 to 6% to really be considered that this is an economy that's overheating and there has to be some real aggressive action. But this just goes to show you how sensitive the market is to inflation. And I think because they know, after the 80s, the Fed and this government is very, very nervous about inflation. As soon as you see any type of inflation, they jump on it, and that's what the market realizes here, that as inflation moves up, the Fed's probably going to try to, move a little more aggressively, and that's what's being discounted here.
Yep. Mark, thanks so much for coming on. We're up against the clock. Going to have to cut this short. We can't wait to have you on soon again, to have you circle back through the program. We enjoy your perspective. Mark Minervini. We'll catch up to you soon, Mark.
Thank you.
You bet. More to come on the other side of the break for Money Sense at the opening bell. As always, Mark is a trader. Many investors aren't traders. We have a different perspective. We think the market is still constructive here, and so we always want to make that difference. Our guests' opinions are their own. We enjoy having Mark on. We'll get his trader perspective again in the near future. We'll take a quick break. We'll be right back.